Okay, I really hate to be the bearer of bad news, but the Feds have made a mistake. The rate cut is going to cause a recession. It's going to cause a pullback. Things are not looking good. It's really best to sell your stocks right now. Start getting into a better position, mostly cash in your account. Things are not looking good. The market's going to probably have a massive pullback, maybe even crash. Things are really not looking good right now, especially this week and the coming weeks into the election. So you should just give your shares back to the market because it's much safer this way so you don't lose a lot of money. Well, these are the things that they're saying all over the internet, all over YouTube, mainstream media.
Our next guest is warning that he's seeing some recession indicators flashing red.
Our guest says while analysts are awaiting a soft landing for the U.S. economy, he thinks a recession could unexpectedly hit.
You hear that nonsense? It's all BS. You see, when 2021 hit and the stocks were all on the rise, the market started to pull back like crazy and it dumped, and big hedge funds, institutions, they moved their money out of the stock market into a money market account, big amounts of money. They invested in bonds and T-bills. And what happens is the stock market pulled back a lot in 2022, came back up. There was some recovery in 23, but there were some decent flat spots in 2023. However, now the stock market is near an all-time high, and yet they're saying there's going to be a recession or a major event in the market that's going to pull back. I'm not quite understanding or following this sentiment because it makes no sense. The stock market right now is in a 15-year bull market, even with 2022 factored in. We're also still normalizing from the pandemic. In the past, the Feds weren't as transparent as they are today. In fact, they won't even be quiet now. They won't stop talking. But beforehand, investors would have to guess what the Feds were going to do when they were cutting interest rates, but not anymore. Over the past 40 years, the Feds have cut rates 12 times. And these 12 times, the stock market was near all-time highs. All 12 times, the stock market was about 15% on average higher within 1 year of the rate cuts. I'm going to read you guys some data and show you some graphs on the screen of why the stock market is actually going to do better after rate cuts. We had a 50 basis point cut. We're going to get another 50 or 225s by the end of the year. And we could see another 75 or even a full point next year. But we're already pretty much on par for another 50 basis point cut. So is this a good thing or is it a bad thing? Well, it depends. If it's proactive during a soft landing and the economy is already under recovery and doing well, it almost always, literally almost always gives the stock market a 15% average gain or upside bull run in the following year after the first cut. So let's dive a little bit deeper into rate cuts. Do rate cuts with the stock market at or near all-time highs provide bulls additional fuel? The Dow Jones market data ran back the tape. They found that since 1990, the Fed has cut rates 7 times while the S&P 500 was at or near within 1% of an all-time high. And out of these 7 times, 2 of them were right before the pandemic. 1 year after the cut would be in the middle of the pandemic. So I don't really think that's an accurate reading because of course there's going to be a pullback during the pandemic. In 2020, everything tanked at some point. So realistically, there would be 5 times, and 4 out of 5, the market within 1 year was up a pretty decent amount. And once out of those 5 times, the market was down. Now, I already read you guys what happened with JP Morgan and Chase's analyst on the previous 12 cuts over 40 years. This is some different data on different dates. So you can see, though, that more times than not, rate cuts when the stock market is at an all-time high or near an all-time high, most of the time, the stock market runs pretty good and it's a bull market and it returns a decent percentage by the end of the year. In 1991, it was 3.8%. In 1991, again, it was 5.9%. And then in 95, it was 11.3%. So there's some decent runs there. In those instances, the stock tended to rise on decision day up to 71.4% of the time with a median gain of 0.51%. 6 months later, the performance is mixed, rising 57.1% with a median gain of 0.62%. However, analysts at JP Morgan ran the data back 40 years, finding that the Fed has cut rates 12 times with the S&P 500 within 1% of an all-time high. The market was higher a year later, all 12 times with an average return of 15%. That's interesting, but it doesn't really tell investors much about the stock market's direction over the course of its easing cycle. As countless market watchers have pointed out, it really tends to depend on the economic backdrop. Historically, only half of the bond rally has occurred by the time of the first cut arrives. The direction of the equity market is less clear-cut wholly. Historically, only half of the bond rally has occurred by the time of the first cut arrives. The direction of the equity market is less clear-cut wholly dependent on whether or not the Fed has averted off of a recession, or whether this rate relief came too late, as we have witnessed so many times in the past. The danger this time around is extreme level of complacency and widespread consensus that the business cycle has been repealed. I also looked at other data, studying different analysts and how things went over the past 50 to 100 years in the stock market. And we really can't be sitting around FOMOing and being scared and being shaken out of our stocks. They want to bring all of this money, which is like $700 or $800 billion from money markets back into the stock market. And they really want to shake you out of your stock so they can tank it. You'll end up selling in the middle or the bottom. They'll buy it at the bottom. And as it starts skyrocketing, you'll miss the move and buy in at the top like you always do. You buy at the top and sell at the bottom. They buy at the bottom and sell at the top. And they keep rinsing and repeating this and taking your money and shaking you out of your stocks. Calculating historical performance data is one of the go-to moves. It's important to understand the booms and the busts. The South Sea Bubble, the Panic of 1907, the Roaring Twenties, the Great Depression, the Nifty 50, the Great Inflation of the 1970s, the 1987 crash, the Japanese asset bubble of 1980, the dot-com boom and bust, as well as the Great Financial Crisis. You had the crash and the housing crisis of 2008, and we also have the big pandemic that happened just 4 years ago, and we've had that inflation that happened in near recession, but that didn't happen. Don't forget the flash crash about 10 years ago in the stock market over a lot of foreign affairs. These periods help define the human condition, from fear to greed, panic, euphoria, jealousy, and the fear of missing out and more. But market history requires context and perspective. It can help you prepare, but it's not a foolproof way to predict what comes next. Time in the market beats timing the market. Warren Buffett also wrote, if past history was all that was needed to play the game of money, the richest people in the world would be librarians. And you see, he's not lying about that, because if that's all that was needed to be rich, he's telling the truth. There's a lot more that goes into it. You have to learn to control your emotions and kind of think forward and understand the companies you're putting your money into, understand the sentiment and the news and the world economy that's happening right now. And there's also relativity on what other people are thinking, what they're likely to do, panic and fear, greed. Like, this very difficult in order to understand the market like this. But realistically, if you have control of your emotions, you should have no trouble. And I teach this to my students, and I say this all the time. If you can have control of your emotions and your psychology, you will have a lot less trouble in the market. It's pretty much 70 to 80% of what you need to know in the market. You need money, you need strategies, but most of it is psychology, emotional control, no impulse. Do not act on impulse. And I teach my students to do this. I have students in the Discord that are up 10 to 15% the first month. I have other students that are up 30,000. They start with 50. Within 2 months, they have 80K. I have other students that were in the hole on their $10,000 account in the negative 5,000, and now they have $15,000 to $18,000, and they are up basically 100% in 2 to 3 months. If you are looking to improve your financial health and your financial freedom, I would love to help you, but it's a very serious mentorship. You have to take it serious and be committed. I offer a full training course, Discord, to surround yourself with people like us so you can learn and grow. And I also offer full coaching, one-on-one coaching. So if you guys would like to grow your financial wealth, maybe you want to retire, maybe you just want to get better at trading, whatever it may be, I would love to help you. You can sign up at investwithcorey.com right there on the screen. The link is also in the information box below. Inflation seems like it's under control, and the Fed is cutting rates with the stock market at all-time highs, which I've already explained is good. And it feels like this means either the coast is clear or we're on the verge of a collapse. It's hard to believe, but when we've been in this situation before, kind of. I had the research teams have looked at forward 12-month returns from every initial Fed rate cut since 1957. You can also see a breakdown of whether the initial rate cut came when the market was within within 5% of an all-time high or not. The one-year returns following the first Fed rate cut have been pretty good. The average returns are, well, average. And 5 out of 7 times when the Fed started cutting rates near all-time highs, the market was higher 12 months later. So you guys can see by the graphs that were on the screen exactly how well this usually works out. And it's really a good thing that the Feds have cut rates while we're on the cusp of a better economy. Inflation is dropping like a rock. PMI data is showing pretty good improvements and some stability. Inflation is going down from 3.2% to 2.9, now to 2.5, and it keeps going down. And not only that, unemployment's going down and jobs added is going up. Things are getting better, and they're trying to fearmonger you, get you out of your stocks. That's the name of the game. They want you out so they can get in, and it's all lies. The mainstream media, everything's all lies. When you really think about it, the big pullback that happened in August, remember, everybody was panicking at the beginning of August, saying, oh my God, I got to sell. The stock market dropped like 10, 12%, some stocks more than that. It may even been more like 15%. And yet I held, I told my Discord to hold, and they did. And guess what? It moved all the way up, even higher than it was before the pullback. And I know a lot of you guys are probably upset if you got out, but it's your fault for getting out, really. I mean, you have to not allow that to happen ever again. Don't get shaken out of your stocks. Do your due diligence, and don't sell just because there's a pullback. Remember, time in the market beats timing the market. It's really hard to time these things. And when you get into a position where you're losing, time will help you, especially if it's a good investment on a good stock. See, if you get in at $10 and you get out at 20 a year later, does it matter where the stock goes in between? It doesn't matter. You got in at 10, you got out at 20. If it drops to $1, runs to 100 and falls back to 20, it does not matter. You got in at 10 and you got out at 20. In between your entry and exit is noise. If you're long-term holding, that's really the strong suit of an investor. And there's a difference between trading and investing. I teach both, and I have a mix of both: swing trading, weekly trading, and investing long-term, running the wheels strategy, as well as retirement strategies, dividends, double divvy, triple divvy. I have all these different strategies, but the longer you're in on good companies, the safer it is. And you can make up for losing trades by spending more time in the market. Look, this is something I said, like I teach in my Discord. If this is confusing, you're losing money in the market, you want to retire, you guys can sign up investwithcorey.com. I truly care about helping you guys. I will show you things that you never thought possible or you never thought you could learn. All of my students say the same thing. They can't believe how much they've learned, and the way I teach is completely different. I care. I truly do. I'm driven every single day. I'm already rich. I have $2.5 million. I don't need any more money. I do this to help you guys because I told myself when I made it, I would work something out so that everybody else could benefit. That's exactly what I'm doing. I'll see you guys on the next video. Thanks so much for being here. Be safe. Take care of yourselves.